Good afternoon. Welcome to the TheoTRADE afternoon video. I am Blake Young. Today is February 1st, 2024. And today we're going to discuss, will employment report confirm massive layoffs? We've had a lot of announced layoffs over the last couple of weeks, actually the last couple of months, that are a dire warning to what the economy may do in the upcoming months. So as we're watching the move and we're seeing equities rally, and we know that the Fed is leaving rates unchanged and likely not cutting rates in March, and maybe not even cutting rates in May based off of yesterday's comments, today's bullish move may seem daunting to assume a bearish position. However, the employment data is shifting and shifting dramatically. So let's go take a look at the raw data and the information we're receiving. To start, I've grabbed a couple of websites. This is called layoffdata.com/data. And this is just talking about per state, the layoffs and the warning notices, the notices telling us that there are layoffs coming, and how many notices are out there and how many affected workers. This is broken down by state. But as you can see, there have been, most recently, 61,000 notices, which will impact 7 million workers. So the question is, if we're going to see 7 million workers affected by layoffs, what is that going to do in conjunction with jobs, employment, and economic growth? A couple of other data points we're going to look showing some of the recent layoffs from Intelens, or however you say that. And you can see some of the most recent layoffs. January UPS will cut 12,000 jobs as a bid to save $1 billion in costs. So they're going to try to save costs. And you can see then we have some leading companies that are having significant layoffs. And it tells you the number, 35,000 from UBS, Accenture, 19,000, Amazon's going to lay off 18,000. If we want to break this down into companies, we can see some of the most recent announcements and some of the pressure there. And you can see just in the last few weeks, just in January, Microsoft announced they're going to lay off 1,900, Lloyd's 1,600, Vallejo 750, eBay 1,000, Salesforce 700, and Salesforce is one that I've been watching for a sell-off. Citigroup 20,000 that was announced just a few weeks ago. So as you're scrolling down, you can see all these layoffs that were announced in January. But if we go back into December, we can see they didn't give us a number, but Xerox said they're going to lay off 15% of their workforce. Bolt 20%. Scrolling down even further, you can see some of the big numbers that we have going back through December. 3,500, TD Bank 3,000. As we're looking at this, 6,000. There's a lot of layoffs. Maersk 10,000. So tons of layoffs are going on in the market. How does this tie into the number of jobs available and the people employed? Now, JOLTS has shown a significant number of jobs availability. We saw those reach all the way up to about 11 million jobs available. Well, that's now dropped down to 9 million. You can see the number of unemployed persons per job opening is climbing. If it gets past 1, you know that you have more unemployed people than jobs available, which means there's not going to be jobs available to give everybody a job. You want to see this down in this half, 0.5, telling us that there's 2 jobs available for every person. And that's the reason we look for that, is because not everybody qualifies for every job out there. So if we have 2 times the number of jobs for every person available, we know that we have a significant number of job availability. We can see that it gets really ugly when we have 6 people unemployed for every job that was available during the 2008-2009 crisis. And we can see that spiked up here in 2020 as well. We're going to be watching those numbers going forward. But tomorrow is non-farm payroll, unemployment, and employment data. As we look at that data, the things that I want to know is not only do we have 9 million jobs still available, and if we're seeing 7 million people being laid off, this 9 million jobs means nothing. If we go look at the number of people not in the workforce, we can see last month we had 540,000, so in other words, 100 million people not in the labor force. 100 million people that are not in the labor force. If we're going to increase that by 7 million, just with the layoffs, the most recent announcement of layoffs, that is going to be the highest level that we have in the last decade. It already is the highest level going back to 2021 and 2020. So as we're leaving the COVID pandemic lockdowns, we had a significant number of people not in the labor force, and this is already matching the highest number. You can see the highest number we had through there. I guess close to it, I should say, in early 2021 after the lockdowns were at their peak. So we are rising. We can see this number going bigger and bigger and bigger as far as the number of people not in the labor force. And you say, well, but we're already showing that we're hiring more and more people. Let's take a look at the data there. And we'll use Forex factor for this one. You can see that the unemployment, or the employment rate, the new jobs, the net new jobs, as you can see, is 187, 187, 336, 150, 199. Last month it's 216,000. So you say, wait, we made 216,000 jobs. That's excellent. We like to see 216,000 net new jobs. The problem is that we have to have about 250,000 jobs just to meet the average increase of the workforce. Just the average increase of the workforce. We don't want to have 100 million people out of the workforce when the workforce is growing faster and faster. So let's take a look at the workforce total. The civilian labor workforce, you can see through here, is 167,451,000. That means we have 100 million people not working, 167,451 working, and that's what gives us this participation rate about 62%. But when we see month over month, year over year, this number can increase from 167.1 to 167.8. That's 700,000 people came into the workforce. If you had 700,000 people come into the workforce and not 700,000 jobs, that's telling you that we don't have enough jobs for the people reaching 16 years old and the people that have not retired out. You can see 897. This one did drop a little bit and then went right back up and then dropped a little bit. And so if we go back up, we might see it bump up like we did in the previous month, 400 to 500,000 people in the workforce. If we see 400 to 500,000 more people added to the workforce and only see 200,000 jobs, that's actually a net worse employment situation. And we do need about 250,000 jobs just to meet the growing workforce on average. So as the growing workforce is hitting 250,000 and the number of jobs are becoming less available as we drop from, if you go back and look at the percentage through there, we'll go there, you can see we peaked out almost at 12 million jobs available and now we're at 9. So we've dropped about a third of all the jobs that were available, and yet we've announced 7 million layoffs. And what you're not going to see in this data and the numbers we just looked at, the 7 million jobs being laid off, is the freezes in hiring, saying we're not going to hire any, which means that JOLTS number is going to go down regardless of layoffs. And it doesn't also show you the small businesses. You're not going to see the moms and pops that fire or lay off 10 people or 5 people. And when we see hundreds, if not thousands, of small companies reducing their workforce, those aren't going to show up in these major announcements, but are absolutely going to show up in the total number of people employed. I think a really good example of the employment level, the number of people employed, that does not reflect what we look at in that non-farm payroll number. So if we look at last month, we said what? Well, last month, January, we reported we made 216,000 new jobs. However, when you look at the Bureau of Labor and Statistics, the number of people employed, we declined almost 700,000 jobs, or 700,000 people employed. So even though we created 200,000 jobs, the number of people with jobs declined by 700,000. And now if we're announcing 7 million in layoffs, this number is only going to go lower and lower and lower. So even if we create new jobs, if new hirings occur, it does not reflect how many people are actually employed, whether going into retirement and taking them off the table. This is the employment ratio. So if we look at the employment by population, you can see that number is getting lower. We're dropping in this case. It doesn't matter if unemployment is going up if the employment number is going down, because the unemployment number is really just reading who qualifies for benefits. So this is a big number. This month is a huge number, and we don't even know if we're going to see those 7 million layoffs start to appear in this month's report. I'm going to guess no. I'm going to guess we're going to see a slowdown. We're probably going to miss tomorrow, but in March, April, and May, as those layoffs are issued and go pushing forward in this first quarter, yes, it'll save the company's money. Yes, UPS will save $1 billion, but at some point it'll show their earnings are higher, but their total revenues are lower, and we're going to see an economic slowdown if this data comes out the same way it looks like it's going to. We're talking about 7 million less people employed. Now, if we look at the total people in the workforce again, and not as a percentage, but as the total number, 7 million. If we really do see 7 million layoffs without an increase in other areas, 7 million will bring this number from 161, 183 down to about 154. And if we look at that, and that takes us right back again into the mix of the 2020 and 2021 lockdown. That is going to be major economic slowdowns. Who's going to get hit the hardest? Based off the announcements, it's the technology sector. And we're going to use XLK and XLC for that purpose. But XLK and XLC, representing the technology, they have the largest number of layoffs announced. It's up 716%. So even though AI is supposed to lift the market and raise everything and everything's going to be great, the fact is we are still seeing the expectation that the market is going to be laying off primarily in the technology sector, 716% higher than last year's layoffs. That is amazingly huge. So as we're watching that move, and we're seeing 716% higher than last time, we're seeing over 152,000 just announced in the last this year. Technology could bounce because, hey, we're saving money, but that means the growth in that sector is going to be diminished as well. So we want to watch for that as an indication that we're probably going to struggle getting through the highs. XLK probably not going to be able to get through there. Despite today's rally, XLK probably not going to get through that recent high. XLC, same kind of deal. I don't think we're going to get back through the gap. We may test the gap with today's lift, but reality is we're struggling even clearing the high. You cannot say we are laying off because we're slowing down and then expect the market to continue to push higher. We can't be talking about laying off an additional 7% of the entire workforce, which would push us into the 10, 11, 12% of unemployment and bring us down participation rate to somewhere in the 50s with those types of layoffs and expect equities to continue to rally. And I do think you'll probably see the reaction in the technology sector first, as we can see that the market is anticipating that they're doing this for a reason. Initially, we get the bump. Hey, you're saving money, better earnings, good investment. But over time, we know that there's slowdown, and that's what we're seeing. The other area that I would watch is to see a peak and a reversal in the leisure area, hotels, restaurants, leisure, the consumer discretionary type spending, but specifically into things like Airbnb. If we know that the market is going to see some adjustments to their employment, the excess and discretionary income is going to struggle to continue to push things like Airbnb higher, or Marriott, MAR. And these are the areas that I would also be looking at collecting premium and selling calls near the highs as we're pushing up into this area. If we see economic slowdown and employment levels leveling off and dropping, or unemployment rising, then the discretionary income to spend at Marriott and Hilton, HLT, like I said, Airbnb, BKNG, Booking.com. These are the areas that I would start to sell call premiums on. Now, same thing could be said for MGM and Wynn and the gambling stocks. If we're going to see less expendable income, these are the areas that we can start looking to short or to collect premium on. Just be cautious with the earnings that are coming up shortly with these stocks as well. Also, Las Vegas Sands. All of them struggling to move higher, not putting in new record highs, already seeing signs and indication that we're going to see a slowdown in hiring freezes, layoffs, which will mean lower expendable income. Last two to look at, RCL, Royal Caribbean. Huge swing, regardless of whether they beat or miss their numbers. The fact is that we've clearly defined a top for Royal Caribbean. Carnival, lower highs, their earnings aren't coming up, but they're making lower highs, lower lows. And I would still say Royal and Carnival could both be shorted, if not just sell calls call verticals against them. And this could last for weeks, months, quarters, and even years. If we're really seeing 7 million layoffs and this is going to feed into the other parts of the economy, this is the area that I'd look to short. Short the technology sector. They're the ones that announce the most layoffs, and then short the hotel, restaurants, and leisure sectors. Well, that's going to do it for me today. Thanks for watching. We'll look forward to talking to you again next week.